Well, thank you very much for inviting me here. It's an honor to be here, and a special thank you to Mickey. The only reason I'm a partner in McKinsey is because of him. He was on our evaluation committee, and he must have been inebriated or somehow losing his mind when I went through the process to be elected. But I also had a chance to meet Mickey again when he was running our practice here. He was what was called the contact director for our Korean practice. So he would come out and basically check up on us from time to time to see if we were, on the straight and narrow of where things were. So I would see Mickey often in that. But also, in particular, as someone with bold thoughts and a view that we shouldn't take the existing system in which we operate for granted. We should challenge it. So what I wanted to talk about tonight for about 25 minutes or so is long-term capitalism, or how business has to change its role and the way it operates with society. And we are at a fundamental crossroads. And there are really three parts to it that I'd like to cover off. One is a bit of context. I'm going to go through that pretty quickly, but I think it is worth just reminding ourselves where we are in the world, because I think we're living in historic times. We're living in times, I think, that we haven't seen for 200 to 300 years. That the amount of change that's going to go on is going to be very significant, and I think all players in the system are going to have to rethink what they're doing in that system, so I want to spend a little bit of time on that. The second is the core, if you will, of what I want to talk about, which is how business needs to redefine its role in society in particular, and there are three areas within that. It's about being more long-term than short-term. It is about managing stakeholder relations and maximizing stakeholder value versus shareholder value. And then the third is owner governance. Those are the three elements of where we think business needs to change fundamentally its views and where it is. And then finally, talk a little bit about some of the actions that we can take. So that's what I want to try and cover off in the next little while. Maybe as a bit of background, the context of the world that we're living in. If you think about the forces at work that are underway today, I'm going to talk about 5 quick ones, which I think any one of them would describe this time period, this next 20 to 30 years, as historic. But the combination of the 5 is what really makes this a time of very significant historic change. The first is we have the re-rise of Asia and Africa. And just to put a simple number on it, from at least my simple mind, we are going to see 3 billion new middle-class consumers enter the world as middle-class consumers in the next 10 years. It's not 30 years or 40 years, it's in the next 10 years. 3 billion middle-class consumers. That is about 1,000 times what we saw in the Industrial Revolution in terms of the number and the time frame. It's going to happen with a larger number of people in a very short period of time. And a lot of that is driven by urbanization and demographics. And no matter what happens to the euro or the US debt situation, or in fact what happens in Syria or other parts of the world, every week we're going to see roughly 250,000 Chinese people move from rural areas to cities like clockwork. You can't stop it. The Communist Party has tried. I've lived in Shanghai for 6 years. I saw the efforts. You can't stop it. And it's relentless. And that is what's driving it. So there's 3 billion middle-class consumers we think is going to have a pretty profound change for everyone, for companies, for countries, for education systems, and so forth. The second big force that's out there, and I see this when I talk with CEOs, one of the things I wanted to do when I took on this role about 4.5 years ago, is to keep externally focused. I have a mantra that I need to see 2 CEOs a day or speak to 2 CEOs a day, and I've done that since I've been doing this role. And one of the questions I'll often ask is, what keeps you up at night? What are the 3 things that you worry the most about or you're excited about? And always technology is one of the top 2. Technology is moving 3 to 5 times faster than management. I don't know whether to be excited or paranoid, but I'm typically both. It's a positive and a negative, and I'll talk more about this in a second. But the technology shifts, I think, are going to have very profound changes, not only in terms of how companies work, but how we think about education, how we think about talent development, how we think about income inequality, which I'll come to in a second. If you just take one element of technology, which is data, we're now as human beings creating more data every 2 days than in our entire existence beforehand. Now, most of that data is useless, but a good chunk of that is also useful. And those organizations that are able to harness that information effectively can get significant benefits from it. But living in a world with massive amounts more of data, there are significant privacy issues, there are competitive issues, there are a whole range of issues that come into that. And again, as a minor point to make, the first CFO in the official terminology came into existence in about 1962. The people had finance directors, but the term CFO came in 1962. If today you were to look at a business and they didn't have a CFO, you'd really wonder what the hell was going on. The new CFO of today, in our view, is the Chief Digital Officer. It's not the CIO. We need a CIO. We need someone who manages the technology, but it's someone who manages that data. So we're seeing, again, organizations. And I would submit to you that for countries and governments and other social sector organizations that are out there, it's just as relevant for them as well. The automation that is going on is very significant. Brian Arthur, who's at the Santa Fe Institute, would say that the size of the automated economy, that's with no humans in it, in the period 2020 will be as large as the global economy was in the year 2000. So just again, in other words, we're going to create GDP growth and economic growth without people. And that's going to have some pretty profound effects, I think, on education, on income inequality, and so forth as we go ahead. We've seen the advent of the 3D printer. Princeton, I think, has just produced the first viable human ear, with a 3D printer. You've heard probably about the duck that was born with 2 left feet. They were able to, again, use technology and print another foot that was a right foot for the duck and attach it to the duck. And these are, again, not science fiction type things that are going on, but they're going to have, I think, some pretty profound implications on how we work and what we do. So technology is a big, relentless driver. And our estimation is it's going to be 3 times the impact of what we saw in productivity growth in the last 2 industrial revolutions. So again, this huge shift towards Asia and Africa, technology shifts, and then we have demographics. The world is actually going to be getting older for the most part. There are some very young countries like many parts of Africa. Nigeria, just as a sidebar, Nigeria will have more babies born in that country than all of Europe combined this year, just to sort of the demographic size of Africa and where it is. But for the most part of the world, we're going to have an older population. For example, just in Asia, which many people think of as a young, fast-growing, dynamic place, we're going to go from having 10 workers for every retiree in the year 2000 to having 3 workers for retiree in 2050. That's going to have some profound implications on healthcare costs, what governments do, what we do as humans in terms of managing our health, what food companies do in terms of what type of products they deliver and so forth. So the demographic shift is going to be unprecedented itself, and the thing with demographics too is it's independent of what's happening in the short-term economy and where things are moving. A 4th area of change is resource scarcity. Resource scarcity, when you have 3 billion new middle-class consumers, in my view, is a reality that we all have to face. As those 3 billion consumers, particularly the ones in China, start shifting from grains to meats, and you look at what happens in the food industry, I know that's a big area that Rabobank is doing a lot in, we are going to see some challenges. I think the commodities industry for the last 70 years has been basically in a decline. It's been a long-term 70-year decline. From about the year 2000, it's shifted up. And while there may be ups and downs, fly-ups as we call them, the trajectory of the line will be up as we try and feed, resource, and supply those 3 billion people. In some work we did with the IFC in the World Bank and 6 of our clients, we looked at water demand and supply, and it's our estimate that in the year 2030, we'll have a 40% excess demand for water than supply. And that's assuming technological improvement in terms of how we do irrigation and use our water and recycle it. So these are pretty significant effects in themselves that are coming on. I think food security is going to be a big issue for the world as we move ahead. And the final area, the 5th change, is actually with our democratic way. And this is way beyond any competency of McKinsey. We're not experts in democracy. But I would say, and it's something that Mickey has been writing about when I think rebuilding society from the ground up, the role and modification of what democratic governments need to do in these times, I think, is going to be on the table. There's a very good article in the Atlantic Monthly by Jim Fallows, who talks about Benjamin Franklin showing up in Washington last year, and how Benjamin Franklin is extremely excited by the technological change, BlackBerries, the cell phones, the internet, but he's equally shocked by how little government has changed in that 200-year time frame. There are still 2 senators from California and 2 senators from Wyoming, because they were similar size in where they are. It makes no sense now, but anyone who wants to make an attempt to try and change the US Constitution is going to get, at minimum, a massive headache in where it is. But our democratic systems and what we vote on and what we don't vote on, very tricky, delicate areas, also needs to be dealt with, because governments are unfortunately having to deal with a lot of the dislocation, the unemployment, the healthcare costs, and so forth. And yet the vehicle of how especially democratic government works is not up to par for the challenges that we're facing as we move ahead. So those 5 forces, we think, are going to have a very profound effect on how the world works. They're all happening together at the same time. I'm an optimist. We were talking at dinner. I believe that this century is going to be a wonderful century for humanity, but I'm always reminded by one of my Chinese clients who said, I agree with you, Dominic, but the question is, will we get through the first 30 years of this century to enjoy the overall century? So that's the context that I want to put out there. And to me, it's a challenge for all institutions to think about what role they're going to play, and we have to move away from assuming that we're working in a fixed box and that the box works. We have to start pushing at the edges of the box. As Mickey said, one of the areas that I'm most passionate about is actually the role of business. And for me, the reason why I became interested in this in particular is when I moved back to the West from Asia, and I don't want to stereotype or generalize things, but I noticed some pretty significant differences in terms of how things worked. And one of the most striking differences for me was actually with the CEOs in particular. And I found many of the CEOs in the West who were competing with players in the East had a big disadvantage, which is that they were very much focused on the short term, even though they didn't want to be. If it was their preference, they would like to be more long-term, but they felt the pressure of the quarter, delivering for the investors, the transparency of the media and so forth that's there. And there's, again, many good things about the changes that are going on, but I noticed that difference. And I remember forgetting, there's a fellow named Anthony Salim, who's in Indonesia, who's a big sort of investor in the food industry. And I was talking to him in Jakarta about the fact we're going to have 3 billion middle-class consumers and how this is going to work. And, it's great how he's setting up this food business. And he told me, he said, you really are a short-term thinker. I said, what are you talking about? This is 10 years. 3 billion, that's a lot of people. He goes, I'm out to 2050. I'm out to 2050 when there's going to be 5 billion. And I'm going to start investing in places that you probably are frightened to go to, because those are places that are going to matter in the future. And I'm building an organization that my grandchildren are going to be proud of. That's what drives me in where I'm moving. And so again, I see this with organization after organization when I compare, particularly the long-term, those companies with long-term shareholders, often they're family owned. That used to be seen as kind of family-owned businesses only last, 3 generations and so forth. There's a lot we can learn from those organizations with these long-term investors and comparing it again to the short term. So that was one shift I noticed. The second was that in many places in Asia, in India, for example, or in Vietnam, and in parts of China, you cannot be a successful business leader unless you're playing a role in your community. You won't have a license to operate. And I learned this in particular from one CEO, the fellow who basically launched ICICI Bank, which is an Indian bank, a guy named KV Kamath, who was completely focused on education and on rural community development. And I'd say, is this a hobby, or how did you get into this? Is this something you were doing because you worked with a development organization in the past? And he said, no, it's part and parcel of being a good businessman. If you're not thinking about how you're improving the society, you don't have a right to operate. And he would always look at me like, how come you don't know that? I'm shocked that you don't think that way. And so it was very much inculcated in the organization that to be able to grow and thrive, you had to be thinking about the society in which you're operating. And I think, again, there's many Asian counterexamples who are short-term, who don't care about that. But it was just, to me, there was a weight of a shift, though, that I saw. And I also saw it in some of the Latin American families. You look at, or investors, Jorge Lehman, who's the one who's bought Anheuser-Busch, which I think used to be, Interbrew. And you think about his model of governance. He said, my ideal model of governance is a long-term minority shareholder with a public market, because I get the best of both worlds. I don't have to listen to the quarter, but I've got a long view. So that was sort of the context. Why McKinsey's working on this is, Mickey said, there's some of my colleagues and some of our clients in the US are not particularly excited that McKinsey's talking about socialist type things. That's typically the word. Why are you guys become Marxists, or what's your deal? What my view to that is basically to say, we're called many names. Most of them are not very good names, but one of them is actually known as the Jesuits of capitalism. And I said, if we're the Jesuits of capitalism, then it's our duty to actually challenge how that system is, because it actually has changed over time. And the last thing I'll say, and I'll get into some of these 3 specific changes we think need to be made, is it's interesting when you go back and look at the core of capitalism, those books that were written, those organizations were around, and one of them surely has to be Adam Smith. And if you look at Adam Smith and you look at his first book that he wrote in 1759, it was called The Theory of Moral Sentiments. He had a phrase in there which I love, and I think we forget about that, and I love to remind my friends in New York of it. But basically it is, the duty of the entrepreneur is to take care of the society in which they operate. It's quite a socialist thing for Adam Smith to be talking about back then, but I think that very much was built into the system. So what's happened, I think, is over the last 10 years in particular, but I think this slide has been going on since 1970. I'll pick a precise date on that in a second, but I think it's been in a slide since 1970, particularly in the last 10 years. It's got worse. You look at trust in business, it's dropped basically everywhere in the world by about 35% over that time frame. It was dropping well before the financial crisis. It dropped even more during that. It's come up a bit, but there's been about a 35% decrease trend. Interestingly, the only places in the world where it's gone up are in the emerging markets, where you're seeing it's gone up in China, it's gone up in Indonesia, it's gone up in Brazil, it's gone up in India, despite all of the things that we read about and see, but it's been going down regularly in the West. And that's Gallup and Edelman who've done a lot of work on that side. We also see this rising income inequality. It's got a lot worse in the last 10 years. If you just look at OECD countries, in 1970, the top 1% had 7% of the wealth. Today, it's 14%, right? And it's worse, obviously, in the bottom 1% in terms of the drop. And given the technological changes, I don't think that's going to get any better soon. I think it's going to continue on that trend. And that has some very significant effects on stability in a society. And I don't need to talk to you about youth unemployment, well over 50% in Spain. When I go to Spain and talk to the business leaders, I say the number one priority is getting youth back to work. Not having that many people without jobs has got to be one of the most destabilizing factors that is in play. And so I think, again, this is a factor. We can't rely on governments to be able to go and sort it out, or some other group that's going to do it. Business needs to get involved in that to be able to drive it. The reason I say 1970 is a time where I think there was a change is because there was a very seminal article written by Milton Friedman in the New York Times in 1970. It was called "The Business of Business is Business." Don't distract CEOs with that mumbo-jumbo social sector type stuff. Their job is to create shareholder value. And again, given the context of the times where you had a number of large corporations the CEOs were distracted and buying things they probably shouldn't be buying and so forth, you can understand some of that. But there was a very, very strong message that it is the business of business to be in business. That's the greatest value add you can provide to society, is to make profit. Because if you make profit, you're obviously doing good things for consumers. You'll then pay tax, in Milton Friedman's term, hopefully not too much. And that's the system. Do not get distracted. Interestingly, there is no, if you look at economics and you look at the theorems that are out there, there is no economic evidence to support that model of how economics work. If business is focused on shareholder value, we're going to create, there's no evidence for that. But that took hold. And then the financial markets as well, the growth of the financial markets, particularly the short-term trading side of things, accelerated, I think, the process that was there. And so we had, the average duration of holdings of stock in the New York Stock Exchange in 1975 was 7 years. Today it's 7 months, right? It's just so the ability to hold the stock as you're moving through it has decreased. We've had much more high velocity trading that's going on. We're seeing today 55% of CFOs will reject. This is a sample base of 3,000 CFOs around the world. 55% of CFOs will reject a positive net present value investment if it means missing next quarter's earnings. 44% of business leaders say they use a time horizon of less than 3 years when they're thinking about what they're doing. Those same people, 73% of them say it should be more than 3 years. So these are not things that the CEO necessarily wants to do, but they feel the pressure that's there. The average tenure of a CEO has dropped from 10 years to about 6.6 years in general. If you take the Fortune 500, it's down to 4.6 years, right? So that the time frame in which, and I remember when I was in China, and we used to have these delegations of Canadian business people. I'm a Canadian. They have lots of board meetings and so forth, and there was always this big group of Canadian business people that would come in. It was the Council of Chief Executives or something. And the third trip, I finally took the organizer aside and I said, "You guys are wasting your time. It's like a tourist trip. You guys come out here, you look around, and no one does anything." I said, "It's just embarrassing. I mean, why? Where's the kind of the investment? What are we going to be doing?" And I'll never forget, this guy said, "What do you think the average tenure is of these CEOs that come out here?" "Well, what do you think?" And I said, I don't know. He goes, "It's about 5 years." To invest in a place like China, where it's taken people like Procter & Gamble and Unilever's and others anywhere between 9 and 11 years to break even, why would they do that? It just doesn't make any sense for them. So of course they get it. They're not stupid people. But it's not in their time frame in which they're going to be able to be making the decisions. And I think when you add up those foregone investments that are going on today because of this very extreme quarterly pressure, we are not getting, I think, the investments that could help with the recovery that we actually need. There's well over $1 trillion on corporates' balance sheets. If you talk to Mark Carney at the Bank of England, he'll say, us central bankers are getting concerned because we've taken the tail risk away from some of the biggest risks that are out there, the euro. Yet there's still some risk, but that significant tail risk has been dropped. bank failures, the amount of capital that's been put into banks, that's been dropped. But we're not seeing the animal spirits. We're not seeing the capital investment that's going on. And interestingly enough, many CEOs and CFOs are seeing that there are opportunities. I'm not just saying it's about the quarterly earnings. There's the uncertainty still in the world. But I think the short-term pressure is a very big one. If we then go to the stakeholders, this is the area where I think there's been way too much of a narrow view in the world amongst business leaders, that if you just focus on shareholder value, everything will work in it. And it's my belief and our belief that if you want to increase shareholder value, you have to increase stakeholder value, or you're not going to be able to operate in the environment. I don't think they're an or, it's an and. You have to be able to be thinking about that environment you're working in. And you can see examples of it. There are many, I think, again, Paul Pullman at Unilever is a great example. And long may the performance still go. I hope it does, because I think if it doesn't, that's when we'll really see how long-term the owners are of that organization. But to sort of say, I want to double revenues and half my carbon footprint and really mean it and drive it, I think is saying something. If you look at Mars, the chocolate company, and what they've done in terms of improving the communities that provide the cocoa and the chocolate in the western part of Africa, well beyond what a shareholder value only person would say it is, but because they believe they need to have the support of that community and the ability for that group to be able to withstand the volatility, they're investing in that. Rio Tinto, a mining company, people may not know this, known as one of the best educators in Africa. This isn't corporate social responsibility. It's actually very much tied to their business. They have to educate local communities on how to operate equipment, how to read and so forth for their businesses to be able to operate. But what they do is they leave behind a much better educated community in where they are. And as a result, they actually are seen as an attractive investor in many places. So it's not, when we say stakeholder, just dreaming up some, the ballet or whatever, those are good things to support as well. It's actually core to what your business is and how it relates to where you're working. The challenge is there's not very good metrics around stakeholder value. It's a nice term to use, but when I talk to analysts about it, they say, that all sounds very good. What can we measure? Give us some measures. Don't just talk about some vague concept. And in our sense, we think the measures are really around what I call health measures versus the performance measures. So it's looking at things like, what is the innovation? I know Renz is here, who's done a lot of interesting work on this side of measuring, but what is the rate of innovation that's going on in that company? It could be patents. There actually are some very good measures on technology companies in terms of the innovation rate that's going on. It's looking at the reputation of the organization. You can actually measure that. Boards can actually see what that looks like in terms of the reputation as it relates to a defined set of stakeholders. It's the quality of the talent that you actually have in your organization. How deep is the bench of leaders that you have in your organization? It's resilience. I think when we focus too much on shareholder value, we're talking about growth and profit and performance. As we all know, a big element about corporate and business performance is also absorbing risks. I got one of my biggest lessons on this from actually the chairman of Samsung. I remember we were talking about risk management, and he said, your McKinsey stuff is way too complicated. I don't understand it, and I don't think you guys do either. The way I look at it is I like to think of ourselves as a 7-torpedo company. And I said, what in the hell is that? What do you mean 7 torpedoes? And he said, he goes, the funny thing about risk is it doesn't tend to come in sequence, an operational risk, a reputational risk, a financial risk. It tends to come in clumps. One risk begets another. And so the way I drive my organization is, can we handle 7 torpedoes coming at the same time? That's how I like to measure the thickness of our walls and our ability to be able to respond to it. And that's what we do in our business planning. And again, you don't see many equity analysts measuring resilience of organizations. And I think in this world that we're in and we're going to see accelerate, which is going to be much more volatile, resilience will be a matter that we need to look at. So when we think about stakeholder, we think that a lot needs to be done around how we actually can measure that and know as a board, know as a CEO whether we're spending enough time driving on that, and it has to relate to what the organization is doing. The third area, because I've talked about, again, moving from quarterly to long-term, and again, by quarterly I'm saying forget about giving earnings guidance. Some CEOs are brave enough to do it, many are not, but say we're not going to give guidance as we move through it. We're not going to operate our business based on delivering the quarter. I'm going to think about our investors in a different way. The stakeholders, not just thinking about the shareholders that are in here, but the broader community in which you're working with, beyond, by the way, employees and customers. I'm talking about the community. The third is this owner governance, and that's really where the boards play a key role. And one of the things that we've noticed over the last 10 years is that boards have actually become themselves more short-term. And again, I'm generalizing here, but this is sort of across 3,500 companies, mainly again in the West. But they've become more short-term, more fiduciary, compliance-based as opposed to strategic. We've done surveys of boards these are U.S. companies, so it's on the U.S. example, the 500 largest U.S. companies. Only 4% of those boards have a strategy committee, right? And again, by strategy committee, I mean that or a committee that's sort of long-term in terms of where they're moving. They have a lot of risk and compliance committees, and that's understandable given everything that's going on. But that is quite a bit different from some of the family-owned businesses that are out here, some of the long-standing Asian companies, also some of the long-standing US companies in terms of where they're spending their time. The amount of time that board members spend on the board is also very different between, for example, a privately held company and a publicly held company. It's typically about twice. Now, as a CEO, it's probably the last thing you want to hear me saying is you need the board to spend more time working on where you are. But I think the issue is more about the board focused on some of these health metrics as opposed to just the performance metrics and where they're going. And I, by the way, think there's a lot that we can learn from the cooperatives. It's interesting, while in the UK, living in the UK, I'm not just throwing this bone out there because we're staying in your wonderful auditorium, but it's interesting in the UK where the trust in business has been plummeting. The one place where it isn't is actually in the cooperative sector. If you think about Waitrose and these places, and there's a sense too of these organizations are actively involved in the community. If you think about how compensation is done and investments and so forth. So I think there's some things we can learn there. But anyhow, the boards, we think, need to think about themselves differently on that front. And one of the most worrying things we found from our research, these surveys we did, was a lot of CEOs found that it was the board members were actually making them even more short-term than the investors were. Because the final thing I want to get to is the investors have a very significant role to play in trying to shift this. We thought it was the short-term oriented investors, including, by the way, some pension funds that were driving it. It's actually a lot of the boards that were putting pressure on CEOs, mainly, I think, because they were nervous about what their investors were going to be doing. But the last thing I just get to in this owner governance is the role of investors. We've sort of done if you will, just a value chain. Everything from the savers putting money into the system to get a return that goes to an asset manager that then goes into a corporate and is dealt with a board, and then the returns come back. There's a value chain. And we're looking hard at where can we one thing to write reports, where could we make a delta in jolting the system? And it's in our view, or at least my view, that a lot has to happen with the institutional investors. We've got to get institutional investors to be behaving long-term. And the surprising thing is there are many pension funds that are thinking about a time frame of 25 to 30 years, but they operate their asset management in a one-year time frame. I think there's some interesting the Dutch examples. I always get the name wrong. PFZW, which I think it's a small proportion of their assets under management. I think about $3 billion where they've invested in 15 to 20 companies with a long-term view, which I think is an example. There's the Canada Pension Plan, which has about $250 billion. Their view is they're managing, when they say quarter, they mean a quarter century. That's what they're managing for. And then they're laying out long-term metrics to say over a 10-year period or 20-year period, this is what we expect. And it's allowing them to focus their investment in more illiquid types of things, but also in companies where they are going to be with them for the long term as they build it out. So I think the institutional investors have a very important role in setting longer-term timeframes in which to invest, demanding health measures, not just performance measures. That the ESG means a lot should mean a lot to a pension fund because they're going to live with the consequences whether we deal with those metrics or not. And then also think about how they do their own performance management. So that's an area that we're focused on right now. The sort of the nature of our work on McKinsey side is working with 3 institutional investors, some of the largest, a Singaporean one, a Canadian one, and a New York-based one, to try and look for ways where we can jolt that system to be able to help drive it forward. Anyway, I'm blathering on here for too long. I hope I've just given you a bit of a picture of, we are living in unprecedented times. I think it's incumbent on all of us, all of our institutions, to step back and think about the role we need to play. And by the way, what's good for the goose is good for the gander, as they say. I think this means not only business has to rethink its role in society and do a lot differently. I think NGOs have to step back and think about their role in society and how they work with the different players, and government does. I'm a big believer in this sort of tri-sector athlete notion. We all need to understand how each part works. It's essential that we have more of a long view in terms of being able to deal with these issues. There are too many to be dealt with in a short period of time. We need to be thinking about the communities in which we're operating, or we shouldn't trust that we're operating and have the ability to operate in this environment. And I think we have to look for the areas where we can jolt the system to try and push all of us into a model. And the last thing I'd say is I think there are many things that are beyond the control of businesses today. Even the US dollar is no longer a sort of a fixed variable. There are very few variables that are out there. It's very difficult for us to make the changes on what government's doing, but I don't think we should worry about that because there is a huge amount that we can just do ourselves to make the system better, so we should focus on that and move it forward. Thank you very much.